Hello all, welcome to this session. In this session, I am going to talk on the asset-based financial services. So let's start with the financial services as we have discussed in the unit 1. Financial services can be defined as the products and services offered by institutions like bank of various kinds for the facilitation of various financial transactions and other related activities in the world of finance like loans, insurance, credit cards, investments, and opportunities. Classification of financial services. So we have a two classification for financial services. One is a fund-based services and second one is a fee-based services. So fund-based in other words is called as a asset-based services as well. So in our curriculum we have a asset-based and asset-based and fund-based is the same. So don't get confused and fee-based is different. Okay, so in this unit we have to discuss fund-based services. So let's start with the understanding of fund-based services. Fund-based finance is specialized method of providing structured working capital and term loans that are secured by account receivables, inventory, machinery, equipment, and real estate. Fund-based financial services FBFS or asset-based financial services are financing method that is driven by the asset of companies. Assets include current assets such as account, receivables, inventory, and fixed assets such as a plant and machinery. So in the simple language, asset-based finance is a specialized method of providing companies with working capital and term loans that use accounts receivables, inventory, machinery, equipment, and real estate or collateral. It is essentially any loan to a company that is secured by one of the company's assets. Asset-based funding is often used to pay for expenses when there are temporary gaps in a company's cash flows or the usual time lag in the cash collection cycle between buying raw. Asset-based financing is a way for companies to use property, inventory, accounts receivable as a collateral to obtain a loan. Asset-based finance is field solely used by businesses, not by individuals seeking personal loans. So asset-based finance is field solely used by businesses. This type of loans may be more flexible than traditional commercial loans. However, the downside of this type of arrangement includes high financing cost. Other names for the asset-based finance industry are commercial finance and asset-based financing, and or asset-based lending also can say. Asset-based loan financing may be used by companies that need short-term working capital to keep day-to-day operations like payroll, for example, up and running. The features of fund-based services. It is an efficient way to finance an expanding operation because borrowing capacity expands along with the sales. It permits borrowers to take advantage of purchase discounts because cash is received immediately upon sales, permitting prompt payment to suppliers and thereby earning the company a good enough reputation to reduce the cost of purchase. So these are the types of fund-based services. Fund-based services are used for creating asset or supported by asset where the funds are transferred into assets, and following are the type of fund-based or asset-based financial services. The first is lean financing, then hire purchase, then consumer credit, consumer finance, then factoring, virtual capital financing, and housing finance. So in between we have insurance services, banking product services, mutual funds, right? So one by one, let's discuss what is uh, lease financing, hire purchase financing, consumer credit. So in this session, I'm covering unit two. First, listening. So let's understand what is a listening. A lease may be defined as a contractual agreement whereby a party owning an assets provide the assets for use to another over a certain time for consideration in the form of periodic payment. Leasing enables a firm to avail the services of a plant or equipment without making investment. So, listening meaning of the meaning of listening in the business is to expensive assets can be purchased and paid back over time. Leasing is a way of renting an asset that the business requires, such as copy machine. Monthly payments are made, and all the leasing company is responsible for provision and upkeep the leased item. Parties in listening essentially involves the diverse of ownership from economic use of asset equipment. Lessors, lessor, lessor is the owner of the asset that is being leased. The lessor means a person who gives somebody the use of a building or area of land. So that means have made a legal agreement. That's lessor. Lessor means the property, the building, the area of a land is he is giving on the rent. And the lessee is the receiver of the service of the asset under the lease contract. So lessee means he is getting that property for some period of time to use, and he will pay the rent as per the lease agreement. Features of leasing: the parties to the lease must be competent to contract. The lease agreement do not provide for transfer of ownership to the lessee, as such transactions are classified as hire purchase. The goods are delivered to the lessee for a specified purpose and period. As I have explained earlier, the lessee is just hiring the place, hiring the some of the land from the lessor for certain period. The lessee should return exactly the same goods after the lease period over. The lease rentals are payable generally in equated monthly installments at the beginning of every month. A number of rental structures are used related to the lessee requirements and projected cash flows. Advantage of leasing: lessee lesser is a full security. Why is as you said he will take the deposit, he will get the monthly equated installments by the lessee. Lessee is financing capital goods, right? Lesser will get the tax benefits. Lessee is less costly. Lesser is a high probability profitability. Why profitability? Because he's not doing any business. He will just receive the rent of the land, right? So he's not doing anything, but he's getting the rent. So this is the high probability. And tax benefits under the tax rule. Lessee can go for the tax benefits with the rent receipt. So trading on equity, lessee leases flexibility in structuring of rentals. Lesser is a high growth potential, right? Because the property rate is just increasing day by day, month of month, right? And less is the simplicity, right? So just now we just completed the listening. In the next session, we will be covering higher purchase finance and consumer credit. Thank you. Best wishes.